Hello everyone, welcome back. And today we'll be starting with chapter 5, which is risk and reward. Now, as you can see, risk and reward in the market is very crucial. Understanding the relation between risk and reward is crucial for anyone involved in the stock market. Now, when we are talking about risk and reward, I want you to understand that when you are trying to invest in the market or trade, perform any activity, carries out a risk. Now, depending upon the situations, the risk can be higher or lower. So, if anybody comes to you and tells you that there is no risk involved in the market, he either doesn't know about the market or he or she is trying to scam you. So, and there's no fixed returns also. The reward will never be fixed. Understand? The reward is judged and given by the market. So, again, factors like when the risk is high, the reward will be high. It's not compulsory, it's not always going to be the same way. And if the risk is low, the reward can also be high or either be low. Again, it's not fixed. So it's very crucial for anyone who is involved in investing or trading. He or she should have a clear picture about the market. Now, see the risk. See, understanding the risk factor is not about predicting the future. Most important thing. It's about being prepared for whatever the market throws your way. Okay, so for whatever the market, whatever conditions arises in the market, you have to be ready for it. For example, if you buy a stock at 450, you should understand clearly that it can also go to 400 or lower, and also carries same potential on the upside. But depending upon the conditions in the market, there's a thin line for the conditions in the market that will judge the pricing of the stock or the movement of the stock. So, if situations where the stock is not going in your favor, what should be your action? What should you do? Depends on how do you manage your risk. Again, reward is not fixed. Either the stock price can go up to 450, come down to 400, then again go to 500, then continue to go higher. Again, reward is also not fixed. We are clear here. Now see, there are many factors also, risk factors like volatility, market fluctuations, company specific risk, and sector risk. Now let us cover all of these four terms separately. For example, volatility. Volatility is the confusion in the price. Explain you. Volatility is the confusion in the price. The price jumping from six. For example, there's a stock. XYZ is the name. This stock is pretty volatile at the level of 650 to 600. The stock price will be jumping from 600 to 650 and then coming down, then going up, coming down, going up. So this is a certain condition that arises in the market. Let's go to the next point, which is your market fluctuations. Understand, okay? Today you buy a stock. So is that again? That stock price was at 600 at the closing. You're averaging at 580. You're getting a profit of 20 rupees. There can be a sudden open of gap down due to fluctuations right away at 530. Now your 20 rupees profit has turned into a loss of 50 rupees. Clear? This is what market fluctuations mean in simple terms. Then we have company specific risk. Yes, company specific risk is there. Now, I'm not going to name some good or bad companies, but see, for example, in any sector, you'll have two types of stock. One is sector winning. Okay. For example, ABC is sector winning, their stock price will be very different. And XYZ, sector losing. Now, ABC will be the most expensive stock in that sector, and XYZ will be the most cheapest. The fundamentals will carry a day and night difference, and again, the conditions for buying and selling in both the stock would be very different. Let's move to the fourth point, which is sector risk. Now, in sector risk, understand there are two sectors here: automobile, auto slash energy. Now, auto has given more returns than energy. Auto again, it's less risky than energy. So there's a huge day and night difference between these two sectors. So if you're, for example, you're planning to invest, it can be whether 8 is to 2, 80% investment here, 20% only here. Or it can be even if you have more sectors, you can add on and you can create a ratio of investment. Now, let's move to the reward. See, I don't want to discuss anything about the reward. The truth about the reward is, again, the reward is judged by the market. Me or you talking about the reward does not make sense, factually does not make sense. We can have an assumption data, not a true data. In the reward, if anybody comes to you and tells you that you can easily make 10K per day into the stock market, does not make sense. Because see, the potential here, the potential can be more, okay, but the potential can be more here, but again, possibility can be very less. Okay, possibility can be very less because we are talking about reward. We have to talk about many things like used capital, okay, for purchasing the stock or entering the trade, level, quantity, averaging, okay, everything. See, reward. If you have all these data, then also you'll still be dependent on an assumption data again, not an exact or true data. Okay, clearly. And if anybody is trying to tell you that, every day you can earn 10K from the market, he or she is trying to scam you. So rewards can be, capital appreciation can be there. Capital appreciation means the stock price going up eventually. Dividend income, yes. If a company announces dividends, then only you'll get dividend income. Portfolio diversification, again, it's not a type of reward, but it will mitigate your risk. Then yes, compounding returns. After a certain period of time, you can have compounding returns. So here we come to an end of chapter 5, risk and reward. So thank you everyone. If you have any questions, please comment down below.